All right, good afternoon and welcome to today's webinar, Construction Contract Fundamentals, Enhancing Project Success. My name is Robert Zelmer. I am a director here on our Capital Project Advisory team. And with me today is Aubrey Gould, a project manager with extensive experience in helping owners negotiate contracts and managing successful projects. As we move through our presentation today, we're going to cover how to identify weak or ambiguous contract terms along with the associated risks, developing audit strategies to enhance contract controls. We're going to share recommendations to improve contract terms in order to strengthen project oversight, and then we'll discuss how to prepare for success before starting the contract phase. So before we get into our content today, I want to start out our discussion with a case study that demonstrates why it's important to review the key terms of your contract before you execute those agreements. So the project we'll discuss here is a multi-year guaranteed maximum price project. And the organization we were working with had worked with this contractor many times in the past. And in fact, at this point, they were working with this contractor on multiple projects at the same time. On this project, they had agreed upon labor rates for their project management staff, who were all salaried individuals, and therefore they didn't qualify for overtime or additional compensation if working more than 40 hours a week on the project. And so as we began our audit activities on this project, we found that the project billings included more than 40 hours a week for this project management staff. And now, as we went through and we reviewed these billings, we saw that there was actually time card support that supported these hours. Now, what we found as we went back and reviewed this is the contractor had gone in and they had removed the terms from the contract that limited project management billings to 40 hours per week. And so again, remember the essence of a guaranteed maximum price contract is that the contractor bills for their actual cost. So in essence, they don't incur any cost for these hours, but they actually remove the mechanisms from the contract that prohibited them from billing for them. So what happened on this is the owner had actually, since they had worked with this contractor many times in the past, they had assumed the contract terms were the same as all of their previous projects, and they accepted the contractor's terms without very much review. And so upon finding this, the owner and the contractor then subsequently negotiated a 45-hour weekly cap for the project management labor hours moving forward. And so what's the key takeaway here? This demonstrates why it's essential to review and assess every contract. And so in this case, the owner was able to mitigate their risk before it turned into a more significant issue. However, had this been identified during the negotiation phase, the owner could have avoided paying the premium for the contractor's project management team altogether. So getting back into the discussion for today, we all know we're currently going through a period of rather significant market volatility, and we're seeing continued escalation of costs, labor shortages, regulatory challenges, all of which can put a strain on your capital projects. And this volatility and the pace at which the current market is changing creates an environment for opportunistic behavior. And the primary control we have to guard against this are the contract documents for the project. So the contract serves as the foundation for your project controls, and even the strongest of controls environments can be unraveled due to poor contract documents. So given the current market conditions, this presents an ideal opportunity to review your contract documents and ensure they're in line with the current market, support and enhance your controls environment, and create the transparency necessary to allow for timely decision making. So remember, a good contract treats the owner and contractor fairly, it rewards the contractor for quality work, and it protects the owner from abusive practices. And a lot of times what we see on projects is where the owner signs the contractor's standard contract with little to no modifications, which, as we saw in the opening example, can be quite a costly mistake. So we'll dive into some of these contract areas as we move through the presentation today, but one of the key considerations for today's market is have you or will you adopt a price escalation clause into your contracts? This can be one of the most effective ways to manage your risk of market escalation. So an escalation clause allows for the escalation of a certain price of labor and materials used in the construction project. These are particularly useful during periods of market volatility and long-term projects. And the clause typically allows for contract price adjustments based on significant changes in underlying costs, but it should also work both ways. Therefore, if you're going to allow your contractor to estimate the impact of any forecasted pricing escalation into the price, and subsequently the market is stagnant or even takes a beneficial turn for you, the owner, the contract should stipulate the owner receive credit where applicable for any escalation that didn't happen. So further, the contract needs to address any ancillary costs that come about as well. So if you're forced to extend the schedule, you need to address what, if anything, the contractor will be compensated for in terms of labor and general conditions. So what else should you be looking for as well? So we want to see the terms that address ongoing industry risks, right? We should have a well-defined change order process. And similarly, we should see a well-defined process for using and reporting the contingency budget. Related to force majeure. So this has required additional attention recently. So it requires additional definition on what specifically is and what is not force majeure. For example, tariffs on construction materials are currently a known market condition. Therefore, while your contractor needs to address this escalation, it's currently a known condition and therefore would not fall under the definition of force majeure. And remember, as you move through this process, owners should always engage experienced construction legal counsel to represent them during their contract negotiations. One of the most impactful steps you can perform, whether preparing for your contract negotiations or preparing for your audit, is understanding how the contract terms, either as proposed or accepted, create risk for your organization. So this could be limited to cost transparency, untimely reporting of significant issues on the project, or other significant risks which could have a deep financial impact and limit your ability to effectively manage the project. Your understanding of the contract terms and how they impact the project set your negotiations up for success, can strengthen your controls and oversight over the project, and can lead to more effective audit programs, better targeting at mitigated risk. So what is a construction risk analysis? So this is documentation of the construction project financial risks and their respective project controls intended to protect the owner's project interest. So as I mentioned previously, this is a step that has a deep impact on your project, your audit planning, and can lead to long-term opportunities for improvement in project oversight. Any audit should always have an underlying objective to identify opportunities for improvement, and performing a contract risk analysis reinforces and supports that objective. It helps with evaluating the current project controls environment and identifying gaps. And so you're able to identify where are you set up for success, but more importantly, where are your gaps? And by identifying this, you've now taken the first steps towards strengthening your project oversight. As an auditor, you can also design your audit program to better address these gaps and put testing in place to further mitigate the risks associated with any identifying gaps. The risk analysis can be used to drive organizational change by communicating within an organization the shared responsibilities for mitigating risk. And finally, identifying contracting improvement opportunities. So when done effectively, these improvements can enhance oversight and controls, leading to more effective project management, avoided risk, and cost and schedule overruns. So now that I've spent some time on why it's important to perform the risk analysis, I want to get into the framework for performing this analysis. So first and foremost is understanding your environment. So knowing who you need to communicate with, when it's required, whether or not or how your work may impact the project are all important items to address. You're going to need to obtain the contract documents themselves. Now, in most cases, this is a pretty straightforward task, but other times this can be a little bit more involved. Additionally, you want to address, are you only primarily concerned with the construction contracts, or is your review going deeper and assessing the contracts of your architect and your other key consultants? And while today we're primarily talking about reviewing the contract with the construction manager, these are concepts that can be applied to your full library of contracts. Understanding the contract type is also key. So are you auditing a fixed price contract, a guaranteed maximum price, or a cost plus contract? And while there's underlying risks that are common to all projects, your analysis needs to be specific to and address the key risks presented by the specific contract type. And then you're going to document the risks you've identified and discuss the potential impact to your projects with the key stakeholders in your organization. And through that process, you'll look to put in place your mitigating controls and assess opportunities for improvement moving forward. So getting into our methodology, the first thing we recommend is understanding your role in the current environment. So is there a path to success, and what does this look like? So do you have the ability to influence the final contract terms and conditions? And if you don't, who are the individuals that own this process, and are they open to recommendations for improvement? Here, you also want to take into account the steps they've already taken or might be currently implementing to improve and update the contract documents. So it's not uncommon for project management teams to continually assess their contract documents and be working through updated drafts with their legal counsel. So in these cases, it's going to be important to understand what actions are already taking place and what has already been identified so you can better assist and not duplicate efforts. Additionally, it's also important to consider any resource constraints the organization may have as it relates to your recommendations. So for example, if your organization typically relies on fixed price contracts and your recommendation is to move towards using or consider using guaranteed maximum price contracts in order to share in potential project savings, you're going to first need to consider, can your organization support the added administration it takes to manage a GMP contract and ensure any savings are identified and managed effectively in the first place? Do you have the skill set in place to negotiate the terms that create the level of cost transparency required to ensure any savings can be identified and obtained? And additionally, who will be charged with reviewing the invoices each month and reconciling the cost support provided by the contractor to the amounts charged for the period to ensure the accuracy of the billings? Now, these invoices can sometimes include hundreds of pages of support requiring you to have resources in place to effectively manage this process. So wrapping this portion up, you can see it's important to understand the environment within which you're working and to understand how your recommendations can both benefit and potentially impact that environment. Our review should encompass the contract package as a whole. So With the construction contractor, not only do we want the agreement such as the American Institute of Architects or AIA A101 or A133, but we also want the general conditions of the contract that define the responsibilities of all parties involved. We want the contract addendums and exhibits, the guaranteed maximum price proposal, or estimates and budgets used in the determination of the contract price. And this may also include the staffing budgets, the project schedules, and the design documents. Now, the reason we need all of these items is oftentimes this creates the contract package as a whole. And what we're primarily looking for are terms and provisions within these supplementary documents that conflict with the primary contract or create additional ambiguity. Now, oftentimes we see language within the supplementary documents like the guaranteed maximum price proposal that amend and update the language of the original agreement. And so our risk analysis needs to take this into account, and our recommendations for improvement or our audit programs need to address any additional risk created by these documents as well. So our discussion today is primarily going to be focused on GMP and lump sum contracts, but as I mentioned previously, you're going to need to identify the contract type and determine the specific risk posed by that contract. Lump sum or traditional design bid build contracts are where the owner has agreed to pay one fixed price for the performance of the work. The key item here is ensuring the scope of this work is well defined in the bid documents to mitigate the risk of excess change orders throughout the project. Guaranteed maximum price or GMP contracts are cost reimbursable contracts where the owner agrees to pay the contractor's actual cost of their work as defined by the contract plus an agreed upon fee. Typically, this is a percentage of the cost of the work, and the cost plus the fee are charged up to a specified cap, the maximum price. The objective is creating cost transparency for the owner and the ability to participate in potential savings throughout the project. Time and materials and cost plus contracts are both similar to GMPs. However, the risk here is that there's no cap to the maximum contract value. So your risk analysis would need to assess if your controls are sufficient to manage the costs and mitigate the opportunity for overcharges. Unit price contracts are those we primarily see on public infrastructure projects where materials and quantities to be installed are specified in the bid documents. The contractor then provides the price for each unit of measure specified, which typically includes the cost of the specified material, the labor to install each unit of measure, such as linear feet of piping, along with their profit for each unit. Your risk analysis here may be centered around terms regarding the reconciliation of installed quantities and identifying any overlap in pricing. As I mentioned, our discussion today is going to primarily focus on lump sum and GMP contracts. So here are the key features of a lump sum contract. So it's a fixed total price for the entire project. It's best for well-defined scope. The contractor bears the risk of cost overruns unless their scope owner changes, and the owner is provided a degree of budget certainty. Likewise, for a guaranteed maximum price, as we mentioned, the contractor is reimbursed for their actual cost plus the fee up to the capped amount. There's a potential to save in project savings. The essence of these contracts is to create greater cross transparency and flexibility throughout the project. And again, here, the risk of overruns is then borne by the contractor and their fee. So comparing the two, both offer a degree of cost certainty. So it's capped at a GMP, and while the final cost may fluctuate depending on the contractor's actual cost, the contract itself caps the price at the guaranteed maximum versus the fixed price where you've agreed to the final amount up front. So both, of course, are able to be adjusted by change orders throughout the project. So this is a key area of focus in the contracts for both. Flexibility. So because of the cost structure in GMP contracts, in certain cases, there's cost savings and contingencies that can be redeployed to cover changes in project scope. And again, through this flexibility comes risk that needs to be managed. And so does your contract specifically define the process for handling these savings? Have you defined the documentation and authorization requirements for contingency usage? And again, we're going to address this in more detail as we move throughout the project. And then moving through the rest in comparison. So risk allocation, the contractor bears the risk in both of these contracts. And your GMP contracts are going to provide additional transparency and in certain cases, more owner participation. So as you get into your analysis, it's important to understand the general architecture of a construction contract. So it defines the fee paid to the contractor. Now, whether that's the entire fixed price, or in the case of a GMP, the percentage of a cost of work, or that could even be a lump sum added to the cost of the work. So the key we're looking for here is clear definition of what the fees are and what they include. Right? So does it include the entire scope of the work as defined in the contract documents? Or in the case of a GMP, is the fee purely profit, or does it also include the contractor's overhead, and what specifically are those costs? Now, general conditions can create some confusion. So there are general conditions costs, which are your contractor's reimbursable costs for managing the project. So things like the project management staff, the job site trailers, dumpsters, and whatnot. And I'll cover more on these costs shortly. Then we have the general conditions of the contract, and most typically this is the AIA A201 document. Now, this is an agreement used in conjunction with the construction contract that establishes the foundational framework that governs how a project is managed, executed, and controlled. The general conditions of the contract define the administrative, legal, and logistical rules that apply across the entire construction project. And your risk analysis needs to include terms of this document as well. Your contract will define the project budgets and should specifically address what are the reimbursable costs and what specifically is not allowable. It should define any project contingencies and allowances. And again, here we're looking for clarity. So are these buckets of costs clearly defined, and what are the documentation and authorization requirements to use these buckets of funds throughout the project? In addition, what happens at the end of the project if there's any budget remaining? The owner should be allowed to recover those savings, but again, your contract needs to set you up for success here. Then your contract will also detail the insurance requirements. So what types of insurance will the contractor be required to carry? What are the terms of the coverage? And this should also include detail on what they can charge for the insurance, whether that's a pass-through of their actual cost for the project or a percentage of the cost of the work. And so here there's an opportunity to bring in your organization's risk management team to assess whether the coverage is defined in your contract is sufficient. So moving along, you have the terms and conditions related to project performance. So your contract should define the process for how and when payments will be made to your contractor, along with the required documentation. It should define what constitutes a change order. So what are the notifications requirements for all parties, along with the authorization and pricing procedures? If you're going to allow self-performed work, does the contract stipulate what will be allowed and the support required to verify it's priced fairly and in line with the market? The contract should define rework, specifically who owns the cost of the rework. So this happens from time to time on projects, whether that's the owner making decisions that require the contractor to remove and redo a portion of the work. There could be a design error that wasn't caught until after the work was installed. And in some cases, work just isn't installed correctly and needs to be corrected. So if your contract doesn't address these items, you could be at risk for paying to have the same work completed multiple times. Your contract documents should also clearly define the scope of the contract, including all inclusions and exclusions. If you don't see this, again, this creates a risk that you may pay for duplicate scope or rework on project change orders. A business ethics clause in a construction contract is essential for promoting integrity, transparency, and accountability throughout the life cycle of the project. And I think we would all recognize that any construction contract should have an audit clause, because without it, you may forfeit the contractual right to examine the contractor's financial records, billing practices, and project documentation. So here we've got a checklist of the key terms you want to review when performing your contract risk analysis. I'm going to touch a few, as I mentioned, I'm going to touch on a few of these items in more detail in a couple minutes here, but unfortunately our 50-minute time slot isn't enough to clearly cover each of these in depth. So as you move through those key terms, here are some of the red flags that you're going to want to address. So first and foremost is vague scope and unclear deliverables. We've got missing or unclear change order processes. The pricing methodology for change orders isn't defined. A lot of us being auditors here, right? Non-auditable elements create a red flag in most of our books. And finally, we've got clauses favoring one party. So moving along, I'm going to spend some time on some key areas of the contract our clients often ask us to focus on. So as I previously mentioned, I want to spend a few moments talking through the contractor's general conditions and general requirements costs. So these are things like your project management team. So their labor costs, you've got vehicle costs for project management. You've got the cost to manage the site, the job trailer, the utilities, furniture inside the job trailer. And then you've got per diems and project management travel costs. Now, when you perform your risk analysis, first and foremost, it's essential to understand the reimbursement terms for these costs. So they can be reimbursed either as a fixed component of the contract or on a reimbursable basis. So in line with our theme for the day, what you're looking for is clear definition in these costs. So if it's a fixed amount, we want to know specifically what we're paying for. That way we can assess whether the contractor has met their terms. So if we're paying for 4 full-time project management staff, we should be able to look at the project records and see if indeed 4 individuals were working on that project full-time throughout. On the flip side, if we can only identify where 3 full-time staff were working on the project, we need to assure we have the ability to address this with the contractor and obtain any potential credits. We might also be concerned with the risk of cost shifting. So what if the contractor overruns the fixed budget? Will the contract provide us with the ability to see if these costs were allocated to other reimbursable portions of the work? So if these costs are reimbursable throughout the project, we still want to see a budget that establishes all the potential reimbursable costs, such as the project management staff and their estimated equipment, along with the unit pricing they propose to bill these costs at. So here again, we'd like to have transparency into how these labor and equipment rates were established. Without that, or the ability to review those rates before agreeing to them, we risk paying overstated rates and additional embedded profits. So some red flags to look out for here are the absence of usage guidelines. If your contract allows the cost of rentals or that aggregate cost of rentals to exceed the fair market value of the equipment price, if we see excessive vehicle or equipment rental rates, and lump sum costs with no backup. So some additional considerations during your review are verify the general conditions and requirements don't overlap. Request rate schedules for all equipment, vehicle, and labor rates. Verify what's included in those rates and understand, what you're paying for and how that compares to current market values. So moving into the change order language, your change order provision should include the following. the definition of a major and minor change order, the authority for approving each type of change order, the authority for using the change order budget, and the change order documentation requirements. So change order documentation should typically include who's performing the work, the cost breakdown of materials and labors with quantities and rates for each. Your contractor markup should be clearly defined in your change order documentation. And you should also see a clear description of the scope of work and the reason why the change order is necessary in the first place. So the contract documents we typically see cover some, but usually not all of these aspects. So change orders, especially what they include and how they're priced, need to be transparent on any project, whether it's a fixed price or a GMP. So as you review your contract documents, you want to see all of these items well defined. This allows your project management team to obtain the level of documentation they need to make informed decisions on whether or not to approve each change order. Without these items clearly defined, you risk overpaying for change orders as well as potentially accepting change orders that include rework and duplicate scope. So moving on to allowances and contingencies. So a construction contingency is a reserved portion of a project's budget set aside to cover unexpected costs. So construction contingency is what we typically define as your bucket of funds for your unknown unknowns. These are the costs that are typically reimbursable that your contractor couldn't have, priced out when they put together their guaranteed maximum price. Your allowance is a budget placeholder used to account for items or work whose exact specifications or costs aren't yet determined at the time of pricing the contract. So these buckets are your known unknowns. So risks we look for when we review these terms include undefined documentation requirements, the contractor's exclusive use of these budgets, which limits your transparency in how these costs are spent. A big one we often see is we don't often see language surrounding how any remaining budgets need to be reconciled at the end of the project. And then we also see risks, certain cases, in how additional fee is treated as it relates to these buckets of funds. So here are some of the guidelines we often recommend. So defining the authorization and usage requirements for allowance and contingencies, requiring full documentation and cost support. So what you would expect to see is documentation that is much the same as you would expect for a change order. We need to confirm how, if at all, fee is applied to its usage. And then the last one, and probably the biggest one to assess, is defining the reconciliation procedures at the end of the project. So how are savings treated and how are they credited back to you, the owner? So the last area of the contract I'll cover today has to do with fees and markups included in the contract. And these could be your CM fee, your subcontractor overhead and profit and fee, your insurance and bonds, and taxes that could be assessed on the project. And some red flags that we want to look out for here are fee calculated on fee. This is something that I've seen come up on quite a few GMP proposals later, where I see the fee actually included in the contract price as cost of the work, and then additional fee is calculated on top of that, creating a circular calculation. Other things to look for in your contract is to ensure that any credits to the project or any scope reductions that result in deductive change orders also include an applicable reduction in the fee as well. Other things to look for are fees that convert to lump sum costs, right? Understanding what the triggers are, to convert to a lump sum and how that potentially impacts the project down the road. And then undefined fees and markets. So again, we've seen in a lot of contract documents where things like the allowable fee on change orders isn't clearly defined in the contract, creating some confusion and ambiguity throughout. So some general guidelines here to look at are verifying what's actually included in your fees and markups and how are those calculated. So confirming ahead of time and making sure your contract actually stipulates, right, how fees are to be calculated. Ensuring that your fees and markups don't overlap with reimbursable costs. So this gets back to understanding and having your contract clearly define what's included in that fee, and then analyzing those costs to ensure that they don't overlap with your general conditions and general requirements cost. And then clarifying the conditions for additional fees and or credits to the project. So again, clarifying, so on change orders, what can fee be applied to? And if there's a deduct to the project, what can you expect for credits?
Thanks, Bob. Good morning or good afternoon, wherever you're watching this webinar. At this time, we're going to take a step back and talk about how you can manage risk even before you start the contract phase of the project. I've grouped these into 3 buckets that I'll be discussing. 1, most important, choosing the right contractor. 2, knowing how your funding sources could impact the project. And 3, having the right price and schedule. So why is number 1, choosing the right contractor so important? It's important because they're going to lead the longest and highest risk portion of your project, and they're going to spend the biggest portion of your project dollars. So you need to vet your options when it comes to selecting the right general contractor for your project, whether that's through an RFP or an RFQ or some other means. These are the items that you should have as part of that process. Have them explain their relevant experience. Maybe you're doing a multifamily project, so you want to go after a multifamily builder, or maybe you want to do a strip mall. Making sure that whomever you're selecting has the experience to back up and the projects to back up that experience in whatever you're wanting to do. Number 2, financial stability, ensuring that they can bond whatever project you're wishing to build, and that there's no pending litigation against them, and that they have money in the bank throughout the duration of your project. So that's requesting financial documentation and reviewing that financial documentation. Vetting on whether they're a good team fit and they have a good communication style. Do you enjoy talking with them? Are they communicative? Do they solve problems or do they just give problems? All these things should be vetted during this period of time. Ask for references. This is one of the most important things that I have found through this process is asking for references, but then following up and calling the references or reaching out to them. I had a client that we were vetting a GC through an RFP process, and we reached out to the references that the GCs had provided, and one GC had provided references that did not give good feedback. And so that was a huge red flag to us that they hadn't gone through the detail of submitting good references, and the ones that they did came back poorly. And so that ended up being a deciding factor not to go with them, is because of those references. So ask and follow up on those references. Ask for pricing. Is the pricing, well thought out? Are they willing to go through it with you? Are they willing to answer your questions about it? 3, how is their safety and compliance? How's their EMR score? Are they, proud to have a safe workplace? That's going to help you have a well thought out construction period and a safe construction period. Second, know how your funding sources can impact the project. So make sure we all have a ton of usually funding sources with our projects in one way or another, and that they're going to impact both how the GC intersects the project and the contract portion of the project. So make sure your GC is willing to be a party to that and work with whatever funding sources you're bringing towards the project. So how do these funding sources usually impact this portion of the project? So we all have heard of usually Davis-Bacon. That's a common one that would impact the GC. There's also the Build America, Buy America, BABA is also one that's coming out. So have a conversation with your GC as to how to approach and incorporate these items into your contracts. Also, procurement method restrictions. I know a lot of housing finance agencies have certain contracts that they like to see, and they don't accept others. So have a good understanding of your funding sources and how they impact the GC and subsequently their contract so that you can have those conversations and that everyone's on the same page working towards incorporating those necessary items. One of the biggest things that I zero into in the contract is how much time does it say that I have to pay the contractor? Because with funding sources, sometimes it can take a long time to get a contractor funded because so many people need to review the draw applications and approve it. So making sure that you're working with the GC, that they understand what is needed from them during this process, and that you're getting it together in a timely manner in order to get everyone paid. Which budget constraints, you're likely to have those, especially, again, with the amount of funders in a deal or even just one funder in a deal. You might not be able to move things around as much as you would like. And so making sure that, again, you and the GC are on the same page about what can move and what cannot move with your construction budget. 3, having the right price and schedule. So you have to have a realistic budget and schedule going into the contract phase. Ideally, this is one thing that you want to negotiate before, because as Bob has noted, there's a lot that goes into the contract. So having these conversations before you get to the contract phase is always ideal. You need to ensure your scope and the amount of funds you have align. Sounds simple in theory, but it's not. So really having a GC on board earlier rather than later in the process makes this a lot easier. Aligning your schedule is also important. So right now I have a situation where there's a tax credit schedule and there's a construction schedule. And so they do not align. And so since they don't align, there is significant financial issues that will arise over this misalignment. And so due to that, we have to go back and renegotiate the schedule, work with the GC to make sure that there's alignment between the tax credit lease up schedule and the GC schedule. So these are all things that you want to get alignment for prior to moving into the contract phase. I'm going to turn it over to Bob, but one thing that I hope you take away from my portion of this presentation is that you need to have the right person in the right seat. So take your time, vet your GC options, select the best GC for your project. Select them early so you can work together and form that partnership, and that partnership is going to help you address all these other items that stem from it to make your project successful and you manage your risk before, during, and after the contract phase. Thank you for your time this morning.
All right, thanks, Aubrey. And so as we move in to wrap up our discussion here, so here are some of the items to summarize our discussion and for your consideration when you're doing your contract risk analysis. So preparation. Um, Understand your project goals and risks to ensure that these are reflected in your contract and set you up for success. Transparency. So ensure the contract allows you to request detailed cost breakdowns that you're able to review throughout the project to ensure that the contractor has met the terms of those requirements. Flexibility. Understand the contingency and change order mechanisms built into the contract and ensure that they support transparent decision making. Balance. So avoid one-sided clauses and focus on creating balance for you and your contractor. And I think it's critical here to remember you're not trying to squeeze every nickel of profit out of the contract. In fact, your contractor needs to have a profitable project in order to be successful. And so what you're looking to do is to create balanced terms that ensure a successful project outcome for all teams involved. Collaboration. Communicate with your stakeholders, and if needed, use things like letters of intent or memorandums of understanding to align expectations throughout the contracting phase and throughout the project. And ensure that the languages surrounding allowance and contingencies are well defined and allow for proper oversight and reconciliation throughout the project. So some additional recommended considerations as well as you work through your contract documents. So engage legal counsel for your contract review. Ask them for their input. What do they typically see? Where do they see additional risk? So as you think of your team, your legal counsel is critical to this process. Require lien waivers. So we've seen contracts that don't require this, or we've seen this term go unenforced on certain contracts as well too. So remember, this is your protection against liens and claims on the project. So this term needs to both be present in your contract documents and enforced. Your shared savings clause, right? So if you've got a guaranteed maximum price contract, right, it should include this clause and it should be well defined. And additionally, some other things to consider with your shared savings, right? Does it address market conditions? If we go all the way back to the beginning of our presentation when we were talking about the current market. So as we look at price volatility, if the contract was priced at the height of that volatility and prices come down throughout the course of the project, right? Does your shared savings clause address that, right? So does simply the change in market price qualify as project savings? Additionally, if there's audit findings or billing errors on the project that result in a reduction in the contract price, again, are these considered savings? So again, does your contract address this, right? And then additionally, right, look at the terms surrounding dispute resolution and how any allowances and contingencies in the contracts are addressed. So some additional items here as well too. So as you look at your contracts, right, your contract type needs to be aligned with both the project scope and the risk tolerance. So whether you're choosing to go lump sum, guaranteed maximum price, or some other form of contracting mechanism, right? We want to look at that and we want to assure that that aligns with your objectives and that the contract type itself, along with those risks, can be managed throughout the project. Review all the terms carefully. So going all the way back to our opening example, right? Especially those surrounding, scope, payment, change orders. We want to ensure that all of those terms are well defined throughout and we don't put ourselves at risk of overpaying throughout the project. Watch for red flags and negotiate proactively, right? And then finally, and if there's one takeaway, from this presentation, it's the negotiation process in your contract risk analysis, your contract documents in general should foster transparency and collaboration with your contractor and with your project team throughout the project. So as we all know, projects operate best when everybody's on the same page. And so again, as we think about the theme for today's presentation, it's that your contract really sets you up for success throughout the project. And so whichever type of contract you're going with, it should still have mechanisms built into it that create collaboration and transparency throughout. And so with that, we're about at time for today. And so once again, I want to thank everyone for joining us here. On screen, you're going to see a QR code that will take you to our Construction Audit Resource Center. And please also join us for our next webinar, Construction Audit Fundamentals, Analyzing and Monitoring Project Labor Costs.